Welcome to the deep dive. Today we're looking at some really interesting sources covering Paradeep Phosphates Ltd PPL, a major player in the Indian fertilizer scene.
Definitely a major player. And these documents really paint a picture of a company in significant transformation, using strong financials as a launchpad.
Right. We see robust results, a big merger finalized, and this massive new investment plan just announced.
It's a key moment for them. The financials are the bedrock Q2 H1 for fiscal 26. We're seeing things like Q2 revenue up, 49% year over year. Huge numbers, about 6,872 crore.
And just for context, a crore is 10 million rupees, so a big jump.
Massive.
So our mission today is to connect these dots. You've got these great financials, the H1 profit after tax, their actual take-home, soaring 135% to 659 crore. Then there's the completed merger with Mangalore Chemicals and Fertilizers, MCFL, and finally, this huge 3,600 crore capacity expansion plan. How does all this together make them, as they say, truly pan-India and maybe more importantly, fully integrated?
That fully integrated part is, I think, the absolute key here. Management clearly understands that today's profits, while great, are vulnerable if they're too reliant on, volatile global markets for raw materials.
So it's about spending now to secure the future.
Exactly. Securing cost competitiveness, locking in margin stability down the road. That seems to be the strategy.
Okay, let's start with the operations then. Because you can't fund big plans without solid performance now, and PPL showed some serious muscle in Q2.
They really did. Production up 19% year over year, sales volume even better, up 30%. That's a lot of fertilizer movement.
It is. But where did that growth actually come from? Was it just overall market lift or something specific?
Well, the sources say it was broad-based, which suggests the whole market is pretty healthy. But they specifically called out value-added NPK grades as the leader.
NPK, nitrogen, phosphorus, potassium, the core stuff.
Right, and some of the specific product numbers are, frankly, astonishing. N20 volumes grew 52% year over year. 52%.
Yeah.
And TSP triple superphosphate sales volume surged an incredible 339%.
Hold on, 339%. That's not just growth, that feels like grabbing huge market share very quickly. How do you even do that?
It points to a couple of things. Likely working together. Maybe they had deep inventory they could push out, or perhaps some really sharp tactical pricing, leveraging their supply chain when maybe competitors couldn't.
Right. Could be taking advantage of the subsidy situation, too.
Could be. Favorable positioning within the government subsidy scheme for certain phosphates would definitely help. It shows they're not just big, they're agile, they can capitalize.
Okay, so agility plus now, immediate news scale thanks to that MCFL merger finally being done. How does that change the map for them, operationally speaking?
Instantly. It boosts their total capacity by about 23%, up to 3.7 million metric tons per annum, MMTPA. That covers both urea and phosphates.
And crucially, it opens up the south.
Yeah.
Exactly. Huge new market access in southern India. Strengthens their customer base overnight, and you get all those synergies, procurement, logistics, blending product mixes. It really makes them a pan-India player in a way they weren't quite before.
But with big mergers and big plans comes financial pressure.
Mm-hmm.
How's the balance sheet holding up? Can it support all this ambition?
Seems very healthy, actually. And quite disciplined. They seem almost obsessed with working capital efficiency.
Okay.
They improve their cash conversion cycle, how fast they turn inputs into cash by 30 days. It's down to 58 days now, which is pretty efficient. Frees up a lot of cash.
And the debt levels.
Yeah.
Because that's key for funding the future.
Right. They kept a comfortable net debt-to-equity ratio of 0.6x. That's the number that signals they have flexibility. They can take on debt for this expansion without, overstretching.
Okay, but one thing in fertilizers is always the government subsidies, right?
Sure.
That affects cash flow. How are those receivables looking? Yeah, that's always part of the picture. The money owed by the government, the receivables, stood at 3,275 crore as of September 30th.
That sounds like a lot.
It is a big number, but the company pointed out about 1,000 crore of that was sort of immediately due. And that clean 0.66x debt ratio suggests they're managing this inherent industry lag pretty well. They still have borrowing capacity.
Capacity they clearly intend to use. Which brings us to the headline item, this massive 3,600 crore investment, the next chapter, as they call it.
This is the big one. It defines their next, 5 years, really? The
Yeah.
goal is ambitious. Push total capacity up to nearly 5.0 MMTPA within about 2.5 years.
5 million tons.
Yeah, and the explicit aim is to position PPL as India's largest fully integrated private sector fertilizer manufacturer, commissioning targeted for the end of fiscal 28.
That's a huge bet. Is there a risk they're overbuilding, especially with all the government talk about like nano fertilizers and next gen stuff? Are they building yesterday's capacity?
It's definitely calculated risk. But two things. One, their current capacity, 3.9 MMTPA, is running at 100% utilization according to the sources. They need more capacity just to meet current demand growth.
Fair enough. They're tapped out.
Right. And second, the government policy, which we can get into, still seems to strongly support conventional fertilizer demand for now, even while pushing new tech. So the 3,600 crore is split strategically.
Okay. How's the money divided? Is it all just pure volume?
Not quite. It's really two main buckets. Bucket one is volume and market reach. About 2,450 crore goes to adding 1.0 MMT of new granulation capacity at their main Paradeep site. That's about capturing future demand.
Got it. More finished product capacity.
Bucket two is about margin protection and self-reliance. Roughly, €50 is for backward integration, expanding their own production of key raw materials.
Ah, okay, so making their own ingredients.
Exactly. Expanding phosphoric acid capacity by 0.5 MMT, that's a huge 140% jump, and sulfuric acid by 1.5 MMT, an 83% jump. And this is spread across both the Paradeep and the newly acquired Mangalore sites.
So more volume, but also protecting the profitability of that volume by controlling inputs. Makes sense. And the funding. You mentioned they have debt capacity.
Yes, they're aiming for a pretty standard mix. 30% from their own profits, their internal accruals, and 70% from long-term debt.
Is 70% debt manageable for this kind of project?
They seem confident, and given the, relative stability of fertilizer demand backed by subsidies, plus the expectation of high asset turnover on this new investment, they estimate 2 to 2.5 times that debt level seems quite manageable, especially with the integration part de-risking margins.
Okay, but there's a timing issue, right? Full capacity isn't online until FY28. What happens in the meantime? How do they keep growing volume in, say, FY27?
That's the immediate challenge, yeah. Management acknowledged it. They have a two-pronged plan for the gap years.
Okay.
First, they'll use trading. Buy DAP, TSP, NPK on the market, and use their now bigger distribution network to sell it. Leverage that pan-India reach.
So become a bigger trader temporarily.
Basically, yes. And second, focus internally on debottlenecking, squeezing more out of their existing plants. They expect that alone to yield an extra 0.2 million tons of capacity next year, even before the big build is done.
Right, let's dig into that backward integration piece more. Spending over 1,000 crore rupees to make their own phosphoric and sulfuric acid. Why is that such a priority right now?
It boils down to supply security and cost control. Hedging against shocks. Think about phosphoric acid, it's a major input. And buying it on the global spot market means you're exposed to massive price swings.
Right, very volatile commodity.
Exactly. So backward integration is it's like them building their own refinery for a key ingredient. They guarantee supply and lock in a more predictable cost structure. It fundamentally changes their risk profile.
A classic industrial strategy. Self-reliance. And the goal is to make all three sites, Paradeep, Mangalore, Goa, fully integrated, reducing that import reliance.
That's the plan. Full integration across the board.
So what's the payoff? Give us the numbers. How much does this improve their margins once it's all done?
Management gave a clear target. Once the full backward integration is complete, post-FY28, they expect the incremental EBITDA per ton, the extra profit margin, to increase by 1,000 to 1,500 per ton.
That's substantial. Where are they now?
Well, their Q2 EBITDA per ton was around 5,200. So this isn't just about small tweaks. It's designed to push them firmly into the higher end of the industry average, which they see as 5,500 to 6,500 per ton. It's margin security as much as growth.
Okay, 1,000 to 1,500 rupee jump per ton. That's the long-term prize. But does anything come online sooner? Any benefits before 2028?
Yes, thankfully. There's a near-term boost expected in FY27. Part of the integration, specifically about 200,000 tons of phosphoric acid and 100,000 tons of sulfuric acid capacity at the Mangalore site, should come online next year.
Ah, okay.
And that piece alone is expected to add about 350 crore of EBITDA in FY27. So, the benefits start flowing early, helping to offset some of those initial build costs.
And underpinning all this is a pretty favorable environment, it seems. Government policy looks supportive of this kind of large-scale conventional fertilizer play.
Absolutely. PPL's strategy involves pushing those higher-margin enriched NPK mixes, yes. But the macro policy provides a huge safety net. The government's commitment to soil health, the subsidies.
Right, that RABI 2025-26 subsidy outlay was massive, 37,952 crore under the nutrient-based subsidy scheme.
Exactly. That kind of number basically guarantees demand for PPL's output, even at 5 MMTPA. It significantly de-risks the volume side of that big investment. They know there will be buyers.
And at the same time, the government is pushing the next generation stuff too, which PPL seems to be getting into.
Yes, that's the other side. There's a clear government focus on promoting nano-fertilizers, nano-DAP, nano-urea. There's specific funding like a 2,000 crore allocation mentioned and budget earmarks.
So PPL's own focus on products like nano DAP fits right in.
It aligns perfectly. It shows they're looking at future product development that matches where national policy is heading, even while they're scaling up the current core business.
Okay, before we wrap up, let's touch on a couple of other things from the sources. The non-financial side, bringing in Rahul Dravid as a brand ambassador, that's quite a move.
It is. And it fits, doesn't it? Dravid's image trust, consistency, integrity, the wall. It mirrors the kind of reliable, solid ethos PPL seems to be building, especially for that rural customer base.
Connects the operational strength to a brand promise.
Precisely. And it's not just celebrity endorsement. They're backing it up with serious outreach, talking about engaging 10 million farmers via 75,000 retailers across 18 states. That shows real focus on distribution depth.
And their sustainability or ESG credentials seem pretty strong too, more than just lip service.
Apparently so. The sources highlight they rank in the top 2% of chemical companies globally in the S&P Corporate Sustainability Assessment. That's genuinely top tier.
And that probably helps with financing too these days.
Oh, definitely. Accessing sustainability-linked loans, attracting certain types of investors, it's a competitive advantage. And they just published their 4th externally assured ESG report, so they're consistent about it.
There was also that one really surprising environmental fact in the sources about the Paradeep site itself.
Yeah, that was fascinating. Their main Paradeep plant site, all 2,280 acres of heavy industry operating flat out, is also documented as a critical habitat for over 30,000 migratory birds. More than 50 species apparently visit every year.
Wait, a major fertilizer complex is also a bird sanctuary? Seriously?
That's what the sources state. It's a really striking example of trying to demonstrate coexistence, I suppose. Goes beyond basic compliance into something quite different. It certainly makes for a good ESG story.
It definitely adds a layer of complexity. Okay, just quickly, any notes on inventory or those receivables again?
Just quick data points. Industry-wide trade stocks of DPNP ATSP were called pretty decent. DAP stocks around 2 million tons higher than the previous year. And those subsidy receivables we mentioned earlier, 3,275 crore as of September 30th, with about 1,000 crore due. Standard stuff for the sector, looks like.
Okay, so let's try and bring this all together. We've seen PPL deliver spectacular H1 profit growth, significantly expand their reach and strategic depth with the MCFL merger, and now they've launched this bold, multi-year, heavily debt-backed plan to become India's largest fully integrated private fertilizer maker. It feels like a company using current strength to fundamentally change its long-term game.
That's exactly the takeaway, I think. It's about building resilience and securing future cash flows.
Yeah.
That huge 1,600 crore investment, especially the backward integration part, is a very deliberate strategy to hedge against that raw material price volatility.
Protect the downside.
Protect the downside, lock in better margins. The next 2.5 years are purely about execution for them. Can they build this complex project on time and on budget to realize that extra euro 1,000 to 1,500 per ton margin? That's the focus.
Which leaves us with a final thought for you, the listener, to chew on. We heard about the massive government push towards nano-fertilizers backed by real money and PPL developing products like nano DAP. So the question is, how quickly will demand for these next-gen nutrients really reshape the Indian market? And what could that mean longer term for PPL's big bet on a 5 MMTPA target that's still largely focused on conventional fertilizers? Something to consider.